Welcome to the Explainer. Today, we're putting on our equity analyst hats and running Selective Insurance Group, ticker symbol SIGI, through a really rigorous valuation gauntlet. We're going to cut through all the typical market noise, look purely at the hard data, and calculate the true intrinsic value of this stock. So let's dive right in. Here is the roadmap for today. First, we'll establish our target stock. Then, we'll run it through absolute and relative valuation models, find our asset-based floor, and finally, deliver a complete synthesis verdict.
All right, Section 1, the target, SIGI stock, and setting our baseline.
To set the immediate stakes here, SIGI is currently trading at $80.88 per share. Now, it's actually seen some recent dips, sitting roughly 11% below its 52-week high. But is this a real discount, or is it a warning sign? Well, we need to look under the hood to find out. What is so fascinating right off the bat is the sheer strength of their underlying fundamentals. Over the trailing 12 months, SIGI pulled in a massive $5.4 billion in revenue. Their 3-year net income compound annual growth rate is an incredible 20.87%, and that is generating a really solid 12.4% return on equity. So fundamentally, this business is highly profitable and growing fast. Moving on to Section 2, absolute valuation models, discounting the cash flows. Let's look purely at the cold, hard cash the business actually generates. We're kicking things off with a discounted cash flow, or DCF model. Now, the logic here is pretty straightforward. A company is really only worth the present value of the cash it's going to generate in the future. So we project the cash flows, apply a discount rate to account for risk and the time value of money, and then calculate a terminal value for when the company eventually reaches maturity. Let's actually plug in SIGI's real numbers. Our source data gives us a huge $1.194 billion in trailing free cash flow. Now, because explicit forward discount rates aren't provided in the raw data, we have to slot in some sensible default assumptions for a mid-cap financial firm. So we're using an 8% discount rate and a really conservative 2% terminal growth rate. And wow, here's where we hit some serious narrative tension. A DCF based on that massive free cash flow points to a fair value of $367.32. But if we run an absolute model based on earnings per share instead, it outputs $152.17. That is a massive spread. We are definitely going to reconcile this later, but just notice right away, both of these numbers are significantly higher than the current $80 stock price. Now, because SIGI pays a regular dividend, we absolutely have to run it through a dividend discount model too. This values the stock based solely on the actual cash physically handed back to the shareholders. Their dividend health? It's rock solid. We are talking 12 consecutive years of increases and an exceptionally safe payout ratio of just 22.63%. The 5-year compound annual growth rate is over 11%. However, the current yield is only 2.13%. So while it's an incredibly safe payout, evaluating the stock purely on this low yield wouldn't really capture the massive upside we saw in our cash flow models. All right, Section 3, relative valuation models, gauging the market. Full transparency here, the source document actually lacks a list of explicit competitors. So we're making a sensible assumption and comparing SIGI against the standard averages for publicly traded mid-cap property and casualty insurers. Looking at the relative multiples, the story is incredibly consistent. We have a trailing PE of 11.06, a forward PE of just 9.56, and an EV to EBITDA ratio of 8.71. Across the board, these sit well below SIGI's own historical averages. Honestly, the stock is currently priced very, very cheaply for the amount of cash it generates. And nothing illustrates this mispricing quite like this number. SIGI's PEG ratio, which measures price to earnings relative to its growth, is sitting at a staggering 0.11. Look, a PEG under 1 is considered great value, but a PEG of 0.11, that means the market is practically ignoring its 20% trailing net income growth altogether. Which brings us to Section 4, asset-based valuation, finding the liquidation floor. To find our absolute worst-case floor, we have to ask a kind of drastic question. What actually happens if SIGI just ceases operations tomorrow and sells off every single raw asset? Well, the source data doesn't give us super granular balance sheet liabilities, so we have to reverse engineer a proxy net asset value. We know for sure they aren't overleveraged because their debt to equity is very safe at 0.25. The EV to assets ratio is heavily discounted at 0.37, but the absolute key metric for our math here is their price to book ratio, which sits at 1.35. So let's walk through the math. The market is pricing the stock at $80.88, right? Which is 1.35 times its actual book value. If we divide that $80.88 share price by the 1.35 multiple, we get the base value of the assets themselves, which is roughly $60 per share. This tells us our absolute worst-case downside risk is heavily limited. Finally, Section 5, the final synthesis verdict, bringing it all together.
All right, here's the full spread from our valuation gauntlet. The absolute worst-case book floor is roughly $59.90. The current market price is $80.88. Our conservative EPS intrinsic value is $152.17. And that aggressive free cash flow value sits way up at $367.32. Think about that for a second. Every single growth and absolute model prices this stock massively higher than what you would pay for it today.
This stark contrast between what the market is paying right now versus our modeled fair values is literally impossible to ignore. The upside potential, strictly according to the math, is massive. But as diligent analysts, we have to ask why this gap exists in the first place.
We need to weigh the strengths and weaknesses of these models carefully. For an insurance company specifically, free cash flow can be really heavily skewed by float. The premiums collected before claims are actually paid out. That completely explains the astronomical $367 figure. Therefore, the $152 earnings per share model stands as our most reliable, most conservative intrinsic estimate.
Taking all of this into account, the source material calculates an aggregated margin of safety of 77.98%. This basically cements the fact that, based purely on trailing and projected financials, the stock is deeply fundamentally undervalued. Which leaves us with this final takeaway. The math is incredibly clear here. SIGI generates massive cash, it's highly profitable, and it trades at a steep discount to its intrinsic value. So is the market simply mispricing a great business? Or is there some hidden, looming risk in the property and casualty space that our financial models just can't see? That is the real question you have to answer. Thanks for joining me on this explainer, and I will see you next time.